Welcome to the B.F. Anderson Techno Fundamental Report for July the 6th. The trend is your friend. Marty Zweig passed away a couple years ago, really great investor, and that is a very, very true statement. There's three trends. There's uptrend, then there's a downtrend, and then there's a sideways trend. You want to avoid sideways and down, and you want to look for uptrends. So let's take a look at an indicator that is designed to determine a reversal of trend in the stock market. Now, this is the Coppock curve. This was developed by a gentleman by the name of Edwin Coppock. He developed this indicator in 1965. And the goal of the indicator is to identify long-term buying opportunities in the market. And the signal is very simple. Now, what's interesting about the Coppock curve is how it's calculated. It's a very interesting formula. It encompasses time and it encompasses human behavior. I would recommend, if you want to learn about the calculation, go to Google, Coppock curve. You'll see what I'm talking about. Now, the most interesting and most important fact about the Coppock curve is that it gives very few signals, and it's rare. So there's only been 3 buy signals in the market since 1987. So we get major turns with this signal. Now, if you notice here, the Coppock curve goes down below 0, turns up, breaks up above 0, the bottom is in. Same case here in 2009. Came down below 0, turned back above 0, the bottom is in. Now, also at the top here, I went ahead and constructed this chart where we have the trend meter at the top. And you can see on the trend meter, when you go into the green after being in the pink, it tends to tell you that the bottom is in. So we're kind of getting a double confirmation here. And we believe the bottom is in. I actually believe we've started a new bull market. Now, I just wanted to take another quick shot at demographics. Demographics do matter. It has to do with consumption, has to do with human behavior. If you look at this particular bull market here, which was here was the crash of =87 in there. However, it was a long-term bull market that lifted off in 1982 and peaked in 2000. So it was about an 18-year bull market. And it had to do with, in my opinion, the fact that the baby boomers were in a consumption cycle. Age 35, age 54, consumption peaks, bear market, bear market. Now we've got the millennials, and they're turning 35 in 2016. So if you buy into this, which I do, that would mean that we've got about 11 more years to go, which would be 2035 when the millennials turn 54. And their spending peaks. Now, to kind of look at it another way, let's look at Japan. In Japan, they lost World War II. They went through a devastating period. So did most of Europe. They didn't have babies, whereas we did. That's what caused, when everybody came back from World War II, started having 4, 6, 8 kids. However, the Japanese did not. So if you look here, in 1990, the Nikkei was at 38,000. So it's gone from 1990, from a high of 38,000 to a low of about 7,000. And here we are, 2023, and we still have not gotten back above 38,000. And I do believe the cause of this was their problem with demographics. Wanted to mention sentiment real quick. This is that AAII survey. Now, this is a short-term reading because it's updated every week. This is a short-term reading of sentiment, positive, negative. However, I think there's a way to determine long-term sentiment, and that's by just walking around and talking with people and conversing. So I'm noticing that there's still a lot of complacency out there. I spent the weekend, with family and friends over the 4th. Talked to a lot of people. Nobody wanted to talk about the stock market. But I tell you what, we get into a roaring bull market, that'll change. Now, good news here. This is the new highs on the S&P. We finally broke above 60. And I have said, for several months that we're really not going to see this market get going until we get over 60 new highs a day on the S&P. And it looks like we're getting it. So, again, this confirms that we think the bottom is in and it's time to become more aggressive with your portfolio. Here's the aggression index, which is a measure, an observation of which stocks within the market are outperforming. And so in this case, the NASDAQ is outperforming the consumer staples, which means aggressive stocks, technology primarily, is outperforming defensive stocks, which is things like toothpaste. So you can see here we've gotten a very strong up move, somewhat of a little pullback, but then we're starting to move again. We're above the moving averages. This says bull market. Here we have our three economic indicators. One concern I do have, we're starting to see interest rate kind of creeping up a little bit here. Really would not like to see the 10-year Treasury get up in this area here, but we are seeing an increase in rates. Oil continues in a downtrend, and we're going to talk again about the banks a little bit right here. In fact, let's take a look at that. This is the regional banking ETF. Now here's our trend meter. You can see that the banks, back in March, really started in February, went into a very serious downtrend. Of course, you'd want to avoid that. Trying to struggle around, but we're just in the neutral, what we call the no trend zone. So the bank stocks are just moving sideways, which is better than a downtrend, but it's still sideways. New lows on the New York Stock Exchange are improving. We got a little bit of a blip above 40 new lows here, but very, very stable. This is another positive. Now, I did want to point out the trend indicator for the S&P. Now, remember here, we get down to the pink, we get into the green, the bottom is in. Pink, green, bottom is in. Pink, green, bottom is in. Here we are now. We've gone from pink to green. So we think the bottom is in. One concern, again, I said, something about interest rates that are troubling, but, the inventor of the yield curve has actually come out and said he doesn't think this indicator is going to work this year or in the future, or maybe in the future, but not this year, simply because everybody knows about it. Everybody's talking about it. So I have learned that about indicators. One thing about indicators, you use different indicators. I have an inventory of about 10, 15 indicators that I follow, but you don't use the same indicator for all types of markets. So right now, this particular indicator is saying that we have an inverted yield curve, which tends to predict in recessions. We'll just have to see. Now let's take a look at a company that just to kind of practice our trend following skills. Now realize here that the institutions pretty much dominate the market. They do. It's 80 to 90% of the volume. So when you see a spike in volume here, and in this particular case, it was about not quite 6 million shares. That is not a consortium of grandmothers buying 50 shares. That is either Fidelity or T. Rowe Price or whoever. But this tells you that there is some institutional buying coming into this stock, and then simultaneously it breaks out of a basing area. It has a somewhat of a sideways, again, kind of pulled back again, but then the institutional investors came back in here. Now, this company is called Double Verify. So let's take a look real quickly at the numbers, just because we need to verify that this is a solid company. Profit margin looks good. Return on equity, a little bit low, but again, these companies this is a fairly young company, but I think the most important number is really two numbers. One, their revenue growth was very healthy at 27%, year over year, versus this is as of the most recent quarter. Earnings growth is very strong, 166% increase year over year for their quarterly earnings. Total cash, they've got about 300 million in cash. They do have some debt, not a heck of a lot. It's okay. Current ratio, very healthy. This company really has good numbers. The chart looks good. We own the stock. I just want to mention it in this video. If you have any questions, please let me know. Thank you very much.